Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending February 3rd. We had a lot of activity in the markets this week with the FOMC meeting earlier this week and then the jobs report that came out today on Friday. That jobs report did come in pretty hot and spooked the markets a little bit. Saw some reversals in the market, but nothing major. I did see a little spike in the VIX and a bit of a spike in the dollar, but no real extreme moves there. And so let's dive right into the charts and take a look at what we're seeing. So starting out with the Bitcoin chart here at about 23,500. Looking for a potential correction here. It is possible we might just kind of chop around sort of in a bit of a bull flag at this moment. But I think the most likely outcome is this is more of a topping pattern than a bull flag, and we'll likely see some sort of a correction here. Looking for some sort of a Fibonacci retracement anywhere between that 0.382 or 50% or that 0.618. Those levels would be at either about 21,000, 20,000, or about just below 19,000. So somewhere in that range, I'll be looking for some support there. If we do get that correction, and if we do see it hold support there and take off back to the upside, we'll be looking at probably a price target closer to about 30,000 on the next move up on Bitcoin. And then take a look at the Ethereum chart. Looks like we are hanging out, chopping sideways on Ethereum. And if we do get a bit of a retracement on that one, our 38.2% retracement level is at about 1480, and then our 50% retracement level is at about 1420 or so. So I'd be looking at probably one of those levels for a correction on Ethereum if we get it. This one does look a little bit more convincing that it maybe is holding support above that 15.5, and maybe this is a bit of a bear flag, or a bull flag rather, before we actually maybe move a little bit higher in Ethereum. So we see potentially either outcome on that one. And then we take a look at our total cryptocurrency market class, asset class. We are sitting at above 1 trillion, which is nice to see that get back up above there. At one point we were over 2 trillion at towards the peak of the last bull run, but things are starting to look a little healthier. Looking like that 762 is a pretty solid floor for the total cryptocurrency asset class space, and we'll see if we can hold that 1 trillion level, or if we do get a bit of a correction in Bitcoin and Ethereum, we'll probably dip back down below it for a bit, but things are, I think, still looking somewhat constructively bullish for cryptocurrencies right now, and so as long as the markets hold up, we don't see the NASDAQ collapse, I think there's a pretty strong chance we'll continue to see some upside performance in the cryptocurrency space. Jumping over the S&P 500. So the S&P 500, as I mentioned, had a bit of a down day to close the week out after the jobs report. But other than that, it was a pretty strong week, and I still think we have a pretty strong bull case in place for some further price action to the upside. Still looking for potentially getting at least back up to about 473, 475 or so on the SPY, and potentially even higher than that. But we do have this anchor VWAP to get through, which was right about where we hit resistance yesterday on Thursday, and that was about 418.50. So we do need to see it clear those levels. Once we get through that level, then I think there'll be a pretty high probability of a good move up further. We do have some other resistance on some trend lines here at about 425 and about 453 on the S&P 500. And then taking a look at our breadth measures on the S&P 500, we're above 73% on the number of stocks above their 200-day moving average, and we're just below 70% on the number of stocks above their 50-day moving average. So still seeing some pretty strong breadth numbers out of the S&P 500. And then jumping over to the NASDAQ has been looking really strong recently as well. It did have a big move up to start the day, but then retraced most of those gains with that hot jobs report. So we'll see how it shakes out going into next week. We might see a little bit of a retracement here, but I'm still expecting this bullish trend to continue. And if we're looking for some Fibonacci retracement levels to potentially watch for a potential bounce, that 0.382 level is currently sitting at about 294, 295 on the triple Qs. And then take a look at our Dow Jones Industrial Average. We've been sitting in this bull pennant for quite some time, and there's been a few attempts to break out of it recently. Looks like Wednesday we had a bit of a move up, but ultimately closed still within that pennant line. Then on Thursday we actually opened up above it, but then closed kind of right at that line or maybe slightly below. And then Friday we had another attempt to get above it, but then ultimately retraced once again after the hot jobs report came in. So still looking pretty constructively bullish here. As long as we don't see a breakdown below that bottom trend line of this bull pennant, then I think the most likely outcome is still to the upside. We do have this Fibonacci extension level at about, let's see here, it looks like about 343 or so on the DIA that we need to get through, and once we get above that, I think it'll be looking pretty bullish and potentially looking for The next Fibonacci extension level above that, which is about 366.55, and that coincides with the previous highs that we put in on the DIA back in early January, end of December. And then jumping over to the transports are actually looking really strong here. We did break out of this descending wedge pattern that we've been in for quite some time. We put the top in on that descending wedge pattern back in November of 21, and so we've been kind of in kind of a messy downward slope, but we got out of that just this week, and we saw a really strong move out of the transports this week. Got up above some resistance at this 15,300 level, and then on Friday we saw it come back down, retest that, and hold the support. So as long as we can stay above that 15,300 level, that's looking pretty bullish for the transportation sector. And then jumping over to the Russell 3000, we finally are seeing a couple of candlesticks, weekly candlesticks, outside of this downward trend line that we've been in ever since the beginning of 2022. So that's looking pretty bullish as well. That yellow line is our center channel. That this big trend channel line here has been established all the way back to the Great Financial Crisis. So there's quite a few years of price memory here, and so we did get up to that center channel line, and that acted as resistance today, but I do think that there's a pretty strong chance we'll potentially blow through that this time coming up in the next few weeks. We are above our 50-week moving average, and also above our 200-week moving average on the Russell 3000. So definitely over the last couple of weeks, a pretty big development in my opinion on the Russell 3000 to break that trend line that we've been stuck under, and that trend line also kind of coincided with our 50-week moving average, and so had a real difficult time getting above that. Every time we reached these levels in the past, it was a breakdown. So seeing that break out to the upside is definitely encouraging, and I think a signal that we'll likely continue to see markets continue to rise in the short term. And then taking a look at the Russell 1000 for our large caps, we did break that descending wedge as well. We actually broke it in last week's candlestick, but then we stayed above it this week, as well as that 50-week moving average, and saw some bullish price action to the upside on our large caps. We got up to that Fibonacci extension level at 231. It did hit some resistance and pull back a bit, so we'll be looking for a potential break above that 231 level. If we see that happen, then that's definitely bullish for our large caps. And then jumping over the small caps of Russell 2000, we've been seeing some really bullish price action out of the small caps, and a lot of times small caps will tend to lead the market, and so unless we see a massive breakdown in small caps in the coming weeks, I think that's a pretty bullish sign for both small caps as well as the broader market in general. And we are, looks like, kind of struggling to get up above this 197 to 200 level or so on the IWM, but if we can see it break up above those levels, then looks like we'll likely be continuing to head higher from there, and I think that'll be a signal that the bull market's still intact as well. Jumping over the bond market, TLT started to look like it was going to maybe pop that 200-day moving average. I've been watching this one really closely. I put in some trades on this. I don't typically trade the bond market, but I think it has been so beat up from last year that there's actually going to be some pretty decent abnormal moves to potentially trade off of. And so I've been watching this closely, and the TLT looked like it was about to break that 200-day moving average on Thursday, but then ultimately it broke down below those levels, and then of course the hot jobs report came in and I think screwed people with the interest rates. We also saw an interest rate spike to close the week out. But it's nice to see that the TLT didn't really collapse big time. It actually recovered a lot of the losses from at least the opening period of the day, and the markets still had a gap down though on the day. So we'll need to see going into next week, or can we hold that 50-day moving average. We've also got a pretty tight consolidation pattern between about 105.50 and about 109.50 or so. So we need to kind of break out of this range one way or the other. Looking for a potential breakout to the upside. If we get above that 109.50 level, then I'm definitely going to be very bullish in looking for some big moves to the upside in the bond market. And then similar story with the 7 to 10 year Treasury bond. That's the IEF, and we actually got above the 200-day moving average a little bit more convincingly on the 7 to 10 year on Thursday. We actually closed right at that 200-day moving average, but then still did gap down on Friday due to the jobs report. So similar story here. We want to kind of see if we can hold that 50-day moving average, which is currently about 98, and if we can ultimately get back up and break above that 200-day moving average and get some closes with the price action above the 200-day moving average, then I think we'll be off to the races for some good bond trade setups. Jumping over to the growth versus value chart, we're still seeing growth outperform value. We talked about how each time we've, especially during the bear market last year, each time we really saw growth outperform value, that was a really good signal to kind of get back into a bear market bounce at a minimum. This time we've done the same thing. We've started to see growth really outperform value, and so I think that's been a strong signal that this rally potentially has some more legs. And until we really see a breakdown of that and value start to really regain outperformance over growth, and I think there's a good chance that this bull market's intact as well. I'm going to take a look at our sectors that we're watching. This is for the last 5 trading days for the calendar week, and at the top we can see we've got 3 sectors that are above between 6 to 7% gains on the week. At the leaderboard was retail just under 7%. We also saw ARC Innovation and Home Builders up pretty big, and then a few other sectors that were up between 5 and 6% were the cloud computing, ARC FinTech, communication services, and the ARC autonomous technology. So we're starting to see a lot of these ARC funds starting to pop off again. They had obviously had a really good performance a couple years ago, and then just got really beat up hard in 2022. So we're starting to see some bullish price action out of a lot of these. A lot of people I think call more speculative or less profitable companies, but also kind of exciting growth companies and companies that if they make it through and get to profitability are likely going to be some big future companies, I think, in the market. And then we take a look at some of the worst performing sectors on the week. Still seeing nat gas down at the bottom. Natural gas has just been beaten up. We've hit a few key trend lines that I think a lot of people, including myself, tried to trade off of already. I got in at I think it was around $9 or so on UNG, and it failed basically the very next day, and I had a tight stop loss on it. So still looking like a falling knife on natural gas, although we are fast approaching a DMARC 13 count on the daily candlestick chart. So it seems like we got to be pretty close to exhaustion on this thing and potentially getting a reversal, but we still have not seen that yet. Natural gas is just, I think, having one of the fastest declines we've seen in quite some time, if not maybe even ever. We're also seeing a lot of weakness out of precious metals this week, so we're starting to see metals roll over, and I think it's just kind of due for a correction. It had a really strong move in January and really late part of last year as well, and so I think it's just kind of overdue for a correction, so looking for some pullback in the precious metal space, but I still think the bull market's intact for that. And then we're also seeing some weakness out of energy and oil and gas, and as well as the emerging markets. Emerging markets had a good January, but are starting to kind of roll over from here. And so I'll have to see if that is the end of the emerging market trend or if it's just in a bit of a corrective phase right now. Then jumping over to the global charts here, the VEU, so this is the global economy minus the United States. We are seeing some pretty bullish price action there as well. We are up against this resistance at about just below 55 on the VEU. We got up to there on Thursday and then couldn't quite get through. And then Friday we actually got above it slightly, but then failed back down. But it is still holding above that 200-week moving average. So kind of need to see where we go from here. If we see a breakdown below that 200-day moving average, then we'd likely correct a bit more. But if we can get above that 55 level on the VEU, then we're likely going to continue to see some promising upside in the global markets. But we look at things on a relative basis, emerging markets by the S&P 500, we can see that we had a pretty steep incline. That was a really nice rally on the emerging markets, especially relative to the American markets. But this last week we've seen a pretty big breakdown, and so we're starting to see the U.S. economies outperform emerging markets for the time being. Then take a look at the oil markets. We saw a big sell-off in oil this week. We opened up at about 80 and we closed the week out at about 73, so it looks like we're still heading lower on that. We talked about how this moving average was a really strong area of resistance as we've kind of been declining in oil prices. That's our 21-week EMA, or sorry, the 21-week SMA actually, the blue line there. And so that's been a key area of resistance. We got back up to those levels just a little bit ago back in November, and it resisted and then had a pretty big sell-off. We got back up there last week and then started selling off once again. So I think I've been talking about potentially getting down to this 200-week moving average and retesting it. That's sitting at about 65, 66 for our U.S. Oil prices, and I think there's a pretty good chance we'll get down and retest that potentially maybe in the near future. And then from there, if we can see it hold that 200-week moving average and we start seeing oil move to the upside, then I think that'll be an area that I'll be looking to re-enter the oil and energy trades, as I still think there's going to be some good bullish momentum in the energy space in 2023. Jumping over to the commodity space, we saw commodities roll over pretty big this week as well. However, we're now back down to these levels where we've kind of had these fake outs where it looked like it was kind of breaking down below a key area of support, and then we ultimately get a whipsaw back up above. So that's happened 1, 2, 3. So we're going on number 4 now. And so the question is, does this finally break down and do we head lower, or we get another whipsaw next week and we start to see commodities rip again? So either way, though, we're still kind of chopping around for quite some time. Commodities have essentially been trading around in a range since early September to now, in between this 265 to 285 range. So some sort of resolution either to the upside or downside from there, I think, will give us a strong indication where commodities are heading from here. And I'd say my bet probably is most likely to the downside, but there's been, like I said, at least 3 other attempts already where I thought, well, maybe that breakdown was coming, and it ultimately didn't happen. So we'll have to keep an eye on that. And then take a look at the high yield corporate bond ETF, the HYG. So this got above our 50-week moving average pretty convincingly this week, but it actually gave up a lot of its gains on the week. So we definitely would like to see the HYG get back up above that 50-week moving average. I think that'd be a bullish sign for the HYG as well as kind of the broader market, as this high yield corporate bond ETF oftentimes can give you a pretty strong signal as to the overall health of the market. We can see that last year when the recession hit and we had a really tough year in the market, the HYG just kind of fell off and headed straight down for the most part. And so oftentimes when the HYG is in a decline, then oftentimes the U.S. markets are as well. So I kind of don't really trade the HYG very much, but I kind of use it as a indicator for the overall market health. And so if we could get back above that 50-week, I think that'd be a good sign for our markets. And then take a look at the precious metals. Starting out with gold, we can see we had a big sell-off in Thursday, and I think kind of caught some people off guard. And then we actually had a huge gap down today, and then ultimately sold off even further. We're now sitting at the 21-week EMA on the close, which is about 173. So I think, as I mentioned earlier, gold and silver both just really had a nice run. We started off back in early November at about 150 on the GLD, ultimately peaked out at about 182. So a really strong move out of gold in a pretty short period of time, especially considering gold usually doesn't move very quickly. And so I think we're just kind of due for a correction. So I'm really looking for some of these Fibonacci retracement levels to find support. On the GLD, the next level I'll be watching, which is also correlating with our 50-day moving average, that'd be about 171, 172 on the GLD. And if we fall further below that, 0.618 retracement is pretty common, I think, for this type of move, and so we could also potentially be looking for support at around 169, 170. So I'll be looking for some area of support around one of those 2 levels, and if we can hold that, then I'll likely be looking to re-enter some precious metals trades. But I think for now, it's best to, if you haven't already, take some of those profits if you've been in that trade for a while. And some people, I think, are even looking for some shorts right now. I'm personally not shorting precious metals, just looking for that support, and then I'll be looking to re-enter some long trades once we get back to the upside on our precious metals. I still think we're going to have a great year for precious metals in 2023. And then similar story for silver. We actually had a bit of a fake out. We had this descending trend line here that's been in play for quite some time. If we zoom out a bit more, this is going all the way back to February 21, and so we've had most of our price action kind of chopping around below those levels. We did get a open above those levels on Thursday, which I think got some people excited, thinking we were going to potentially break out, but we ultimately didn't. We saw a huge sell-off on Thursday, followed by a gap down on Friday, and then further selling pressure. So similar to gold, I'll be looking for some level of Fibonacci retracement to kind of find support, and then potentially re-enter some more silver trades, looking for more further upside. So our 0.382 retracement level sitting at about 2030. The next level down at 50% is at about 1960, and if we get a 61.8% retracement, we'd be looking at just below 19 on the SLV. So looking for that correction and looking to find some support at one of these Fibonacci levels. And if we get there and start to see price action move to the upside, my bet is that we'll likely see silver head even higher and ultimately break through this descending wedge pattern we've been stuck in for quite some time. Then take a look at our interest rates. Interest rates on the 2-year had a big move up on Friday. That was, again, based on the hot jobs report that came in. We got all the way back up to about 4.3% on the 2-year. But we are still within this descending channel here, so as long as we don't see a major breakout of this channel, then I think the bias is still to the downside on rates. And then similar story on the 10-year, still in this descending channel, but we did see a strong move on Friday, got back up above 3.5%, closed the week out at about 3.52% on the 10-year. and then our 30-year also sitting in this descending wedge, or potentially might even be a channel ultimately in the future once we see a little more price action develop. But we are still kind of below that major trend line, and it's not a real surprise to me on the 30-year that we saw a bounce. We got to that 200-day moving average and kind of found that as support, and then kind of rallied off of that, which wasn't too surprising. However, the jobs report was pretty surprising today, and so that I think moved a little bit higher than otherwise would have. But again, as long as we don't really break outside of this descending wedge pattern, then I think the bias is still to the downside on rates. And then take a look at our put-call equity ratio. We are still sitting in pretty normalized ranges. Anything between 0.5 and 1 is considered pretty normalized levels. And so last week we did see a brief spike up above the 1 mark, but this week we actually stayed quite a bit below it. We kind of chopped around in between about 0.55 and 0.82 or so on the put-call ratio. So things are still looking pretty good. There's not a lot of panic in the markets at the moment, and I think people are starting to get a little bit more constructively bullish. And then we take a look at the dollar chart. So the dollar did have a pretty big development in the last couple of days. We got down right around to that 100.5 level, which was a key area of resistance, and we did see a rally off of that. Not super surprising to see that rally on Thursday, but what kind of surprised me was the rally on Friday to close the week out. We did break through this trend line, so the big question is this a trend change, and are we going to start moving the upside on the dollar, or is this just a bit of a blip? Kind of based on that hot jobs report, and are we going to see the dollar roll over from here? I think 103 is a pretty strong area of resistance that we've got to contend with. So if it wouldn't surprise me if we rolled over starting out next week and stayed below that 103 level. But really, as long as we're still sitting below that 200-day moving average, I think we are still looking for the dollar to ultimately head lower from here, even if we do see a bit of a rally in the short term. Still looking for ultimately the dollar to move down lower and potentially get even as low as about between 92 to 95 on the DXY over the longer term. And then take a look at the VIX. VIX is still at lower levels. We're below 20. We did get down all the way to about 17 or so, just looks like about Thursday. That was the lowest level we've been at since early January 2022, maybe even into 2021. Looking at, looks like it was January 3rd last time we were below those levels, and so it's been quite some time since we've seen the VIX at these lower levels. We did see a bit of a bounce on Thursday and then also on Friday, but a lot of that VIX moved to the upside ultimately retraced, and we kind of got back down to that 18 level and are just sitting just above that. So still not really any major spike in the VIX, and as long as we continue to see that VIX stay below 20, I think it's pretty hard to argue that the markets are falling apart. Let's go ahead and close it up with a trade setup that I'm in right now. So biotech is looking really good. The IBB has actually got a very strong inverse head and shoulders pattern in place that is just slightly above the neckline on currently. So as long as IBB is sitting and looking bullish with that inverse head and shoulders setup, I've been looking for a lot of trade opportunities in the biotech space, as biotech just got absolutely beat up in 2022. And I think a lot of it wasn't necessarily justified. So I think there's some big upside opportunity in a lot of biotech stocks, and this Fate one looks pretty interesting to me. We are above the 10-day moving average, which is kind of where I've got a potential stop loss set just slightly below that. So we see Fate drop down below 6 or so per share. I'll be out of this trade, but it looks like there's a big potential for a move to the upside. We got that massive gap down not too long ago. It looks like we gapped down in early January, and when we did gap down, we were sitting at about almost $11 a share, and then we gapped down all the way down to $3 or $4 a share. So if we continue to see some upside momentum in this one, I think there's a pretty strong chance we can go ahead and gap fill to the upside on this thing, and that would be, I think, almost a 60% move to the upside. So definitely a bit of a speculative bet on this one, not a super high conviction play, but a very low risk and a very high reward on this one. So since the markets are looking still pretty strong in my opinion, I'm definitely looking to look for some of those bigger upside opportunities, and especially if I can find sector strength where biotech's looking pretty good, and then we've got a real nice technical gap fill potential. This looks like an excellent trade setup for a pretty nice upside move. So definitely check out Fate if you're looking for a good opportunity in the biotech space. So thanks for tuning in, and make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and you can check us out at ToroAlerts.com.